Welcome back to your ultimate pit stop, Piston Pundit. For decades, oil has acted like a high-compression engine for global power, and few places illustrate that better than Venezuela. After sanctions and underinvestment hollowed out its output, the crisis peaked in January 2026, when U.S. forces captured President Nicolas Maduro during a military operation tied to a broader push to control Venezuelan oil assets. Rather than stalling exports, this pressure triggered adaptive responses. Tankers disappeared from trackers, trade routes rethreaded, and buyers recalibrated. This wasn't just a blockade. It was a real-time stress test of maritime logistics, refinery compatibility, and global energy strategy. Here are the developments, strategies, and outcomes reshaping the oil market today. The blockade shock. Caribbean Sea turns strategic battleground. What Washington attempted wasn't a routine sanctions memo, it was a hard stop. Ships halted, cargoes frozen, corridors controlled. In logistics terms, that's the jump from "we'll penalize you" to "we'll physically govern the lane." The Caribbean isn't postcard water. It's a critical artery feeding refineries, storage hubs, and re-export loops. Add naval enforcement and every ship owner, insurer, and buyer recalculates risk instantly. But blockades look tidy on charts and chaotic at sea. International waters, flags of convenience, layered ownership, and fast-changing vessel identities complicate enforcement. Boarding actions deter, yes, but they also expose limits. Each interception carries headline risk and escalation questions. That uncertainty opened space for arbitrage. Markets hate fog, but they thrive on opportunity. Once the blockade began, the system didn't freeze, it adapted. Venezuelan flows didn't vanish. They reconfigured, turning the Caribbean into a high-stakes chessboard where every move invited a countermove. And once physical enforcement showed its limits, the real game shifted from ships you can see to signals you can't. The dark mode Armada, how tankers vanish in plain sight. No submarines here. The disappearance was electronic. AIS transponders, the ship's public beacon, went dark. Kill the signal and you create a monitoring blind spot the size of the ocean. Think of disabling GPS, except the device is a floating steel skyscraper hauling 1 million barrels. Maritime surveillance is pattern-driven. Break the pattern and oversight lags. This playbook isn't new. Iran and Russia refined it under sanctions, building shadow fleets that now function like a parallel supply chain. Venezuela plugged into that ecosystem. Aging hulls bought cheap, shell company ownership, permissive registries, and minimal transparency. Even when a vessel is seen, proving cargo ownership and jurisdiction can take longer than the voyage. Success compounds quickly. Routes sharpen, transfer points standardize, paperwork improves. Dark mode isn't a trick. It's an operating model that forces enforcers into perpetual catch-up. Before we delve deeper, do us a favor and smash that like and subscribe button. This helps us reach more auto enthusiasts just like you. All right, let's shift gears because what's moving through these shadow routes isn't interchangeable fuel. Heavy Venezuelan crude, the industrial fuel markets can't replace. This isn't theater, it's hardware. Venezuelan grades like Mare are heavy bitumen-rich barrels. Many refineries are engineered, cokers, hydrocrackers, desulfurization units, to run that feedstock. Swap it overnight for light shale and you wreck yields, margins, and product slates. Heavy crude underpins diesel chains, industrial fuels, and, especially in China, bitumen for paving and construction. Disrupt those barrels and specific machines feel it. For Venezuela, oil isn't optional. It's the economy's crankshaft. Export revenue funds imports, stabilizes services, and sustains power. When cornered, systems innovate. The twist? Policy shifted from outright blockage to management. Trading houses marketed barrels. U.S. refiners re-entered via intermediaries, tempted by discounts to Brent. Market gravity won. Heavy crude is hard to replace, and keeping refineries efficient often means dealing with the barrel. Either stop it completely, rare, or steer where it lands, pragmatic. And nowhere is that recalculation more visible than in how China plays the long game. China's strategic math: cheap oil, patience, and leverage. China has been the largest destination for Venezuelan oil because it can absorb discounted barrels and process heavy grades through independent teapot refiners. For China, Venezuelan crude isn't just a commodity, it's leverage. Each added supplier reduces exposure to choke points and political pressure, and discounted oil turns energy security into a cost advantage. Recent developments changed the short-term picture. Blockade pressure and tanker seizures slowed departures, forced some ships to turn back, and cut near-term flows to Asia. But this wasn't a loss, it was an adjustment. China stocked earlier, filled storage, and reduced urgency. The real advantage is flexibility. Even if volumes fall, sanctioned oil can still reach Asia through blending or re-export routes. If teapots face shortages, they pivot to substitutes like Canadian heavy blends, triggering global sourcing shifts the automotive and industrial world should watch closely. But China isn't the only player adapting. The most revealing shift may be happening in Washington itself. Washington's recalibration, from stopping oil to controlling it. Washington's real pivot wasn't ships going dark, but strategy evolving. A blockade implies total denial, yet policy shifted toward controlled trade, licensing major trading houses, clearing stuck cargoes, and encouraging investment to revive output. That's not permanent shutdown. It's taking over the tap and deciding who gets fuel. Zooming out explains why. Venezuela's infrastructure is worn, and heavy crude is costly to produce, requiring heat, diluents, aging pipelines, and constant maintenance. Even modest gains won't flood markets, but they can rebalance specific refineries, giving small increases outsized political impact. Caribbean staging completes the shift. Routing barrels through hubs like Curaçao and St. Lucia decouples origin from destination. Once staged or blended, oil is harder to politically label. Trade flows were restructured, and as control shifts from oceans to data, the next phase of conflict is already underway. The next oil conflict: seizures, satellites, and shadow supply chains. When transponders go dark, enforcement turns into a technology war. Agencies rely on satellite imagery, pattern analysis, port monitoring, financial tracing, and intelligence coordination. Synthetic aperture radar can spot ship silhouettes through darkness and bad weather, while analysts flag loitering, mid-ocean transfers, and suspicious paperwork. Even with advanced tools, the ocean is vast, and enforcement resources are limited. Recent seizures show this pressure is real and escalating. Boarding tankers sends shockwaves through insurers, owners, and flag registries, but it also creates whack-a-mole dynamics. Ships rename, reflag, reroute, and hide behind complex jurisdictions. That's why shadow logistics isn't a temporary hack. It's a durable system. The takeaway is practical. Contested oil transport drives up freight rates, widens discounts, and forces refiners to rethink procurement, reshaping fuel prices and industrial costs worldwide. Verdict: why modern oil defies absolute control. This wasn't merely a clash between tankers and warships. It was a stress test of modern power. The Venezuelan oil blockade exposed the limits of raw control in a world governed by logistics, incentives, and interconnected markets. The United States showed it can seize vessels, redirect trade, and influence flows, but only with trade-offs, compromises, and unintended consequences. Venezuela demonstrated that even a weakened producer can survive by exploiting gray zones and rival interests. And the oil market did what it always does: adapt, reroute, and resist absolute control. For the automotive and energy worlds, this matters deeply. Fuel supply chains, refinery economics, and geopolitical risk are now inseparable variables. The road ahead won't be defined by who fields the largest fleet, but by who understands the shadows and designs systems resilient enough to operate within them. Now let's hear from you. Are shadow shipping networks making sanctions ineffective or just more expensive? Should refineries and automakers prioritize flexibility over efficiency going forward? How do you see this reshaping fuel prices and manufacturing costs in the years ahead? Share your thoughts and experiences in the comments below. If you want more deep dive breakdowns like this, subscribe to Piston Pundit so you don't miss the next vehicle updates and upcoming videos. Thanks for watching, and see you at the next pit stop. You can now check out any of the videos on the screen. There's plenty more to explore.